Welcome to this explainer. Today, we're going to demystify one of the most misunderstood, heavily leveraged, and frankly, fragile businesses on the planet. We are pulling right back the curtain on the banking industry. Because, owning a bank sounds like the absolute ultimate dream, right? People just walk in, they hand you their money, you lend it out to someone else at a higher rate, and you just sit in the middle getting rich. But as we'll see, the math behind this whole machine is a lot more precarious than it looks.
Okay, let's dive into this. Most people picture a bank as this ultra-secure storage room. You bring your money in, they put it in a giant vault, they guard it, and then you just come take it out whenever you need it. But that's not a bank. That's a locker. A bank is actually a profit-generating machine. It takes other people's money and turns it into income-producing assets. The exact moment your dollar arrives, it's not sitting in a box with your name on it. It is instantly put to work.
To understand why this is so incredibly unique, think about a normal business, like a bakery. A bakery takes flour and turns it into bread. When they sell that bread, the flour is physically gone. But a bank? A bank's raw material is your money. The product it sells is credit. And here's the core cognitive dissonance of it all. When the bank lends your deposit out to someone else, your deposit is still there. You can log into your app right now and see it. As far as you're concerned, it hasn't gone anywhere. But the bank has also lent most of it out to somebody else.
And this brilliantly illustrates fractional reserve banking in action. You deposit $100. The bank doesn't keep $100 in the vault. It keeps a calculated fraction and lends out the rest, completely banking on the assumption that everyone won't ask for their money back at the exact same time. Historically, if they kept 10%, they'd lend out $90. The borrower spends that $90, the receiver deposits it, that bank keeps $9 and lends out $81. This cycle repeats until your original $100 becomes nearly $1,000 circulating in the entire economy. It's not magic, it's just math.
Now, here's a pretty wild fact. For most of American history, that 10% reserve was a very strict rule. But in March of 2020, the Federal Reserve completely eliminated the reserve requirement. Today, banks literally aren't required to hold any specific percentage of your deposit in reserve. The regulatory focus has totally shifted instead to capital requirements, and the Fed just pays banks interest to incentivize them to hold reserves voluntarily. But make no mistake, the entire system still runs entirely on the trust that people won't all demand their cash at once.
So, let's say you want to build a small community bank capable of making about $100 million in loans. Before you even open the doors, before you take a single deposit or make a single loan, you need this number right here, $15 million. This is your capital. This isn't money you owe customers. It's the bank's own money, your personal cushion against losses. And it absolutely cannot be borrowed. It has to be yours.
And that $15 million, that's really just the baseline equity. The true fixed costs of admission are massive. You'll spend 1 to 3 years just filling out paperwork, and the FDIC won't even approve you unless your plan is bulletproof. Then the ongoing costs kick in. We're talking federal charters, FDIC insurance, huge cybersecurity demands, and endless payroll for risk managers and compliance officers. Plus, you have to pre-fund loan loss provisions to cover the borrowers you know will inevitably default. The money just flows out the door every single day, no matter what.
Now, what's really interesting about this slide is how you actually make your money back. Your primary engine is the net interest margin. You borrow money cheaply from your depositors, paying them a low rate on their savings. Then you lend that exact same money out expensively for mortgages, say charging 6 to 8%. The bank sits right there in the middle and collects the difference. This spread, which is often around 3%, is what pays for all those massive fixed costs we just talked about.
But lending isn't the only game in town. Banks squeeze revenue from nearly every single transaction they touch. You've got interchange fees from card swipes, wealth management, and investment banking. And get this, overdraft fees alone generated nearly $10 billion across banks and credit unions in 2022. Now, regulators highly scrutinize them as predatory, but for banks, it's a massive, extremely reliable fee machine.
When you multiply those tiny spreads and transaction fees across trillions of dollars of assets, small percentages become totally inconceivable sums. To put it in perspective, in 2024, JP Morgan Chase earned a net profit of $58 billion. That is the highest annual profit in the entire history of American banking. It's just pure scale at work.
And this brings us to the true secret sauce of banking: leverage. Most regular businesses use their own capital to buy equipment and generate a return. A bank operates almost entirely on other people's money. your deposits. Because they're generating returns using borrowed funds on top of a very small layer of their own equity, the returns can be astronomical. In 2024, JP Morgan hit a return on tangible common equity of roughly 22%. Almost no other industry on Earth generates sustained returns like that.
So, the crucial point is that leverage is a huge double-edged sword. It amplifies your wins for sure, but it viciously amplifies your losses. If a bank has $50 billion in deposits and $5 billion in capital, the depositors don't absorb the first losses. That $5 billion equity cushion takes the hit. If the bank loses just $5 billion, a mere 10% of its assets, it is entirely wiped out, technically insolvent. This is the trap right at the center of banking.
Section 1. When the math breaks. Washington Mutual.
Under the leadership of Executive Kerry Killinger, WAMU had grown into the largest savings bank in the U.S., pushing aggressively into subprime mortgages to chase higher interest income. For years, the math worked perfectly, until housing prices collapsed in 2006 and borrowers started defaulting. But the true fatal blow wasn't a slow bleed. On September 15, 2008, Lehman Brothers went bankrupt. The market utterly panicked. In just 10 days, terrified WAMU customers withdrew $16.7 billion. The bank simply didn't have the funds to conduct day-to-day business. By September 25th, regulators seized this massive $188 billion behemoth and sold it to JP Morgan for just under $2 billion.
This exposes the absolute most terrifying central risk in the banking business. WAMU's underlying loans didn't all suddenly go bad on that Tuesday. What changed was trust. A bank can be solvent when the sun comes up and completely dead by the afternoon, simply because enough people simultaneously lose confidence and demand their money back.
Section 2. The speed of text message. Silicon Valley Bank.
Silicon Valley Bank was a 40-year-old institution. They survived the dot-com bust and the 2008 financial crisis. By late 2022, it was the 16th largest bank in the U.S. But the reason set up for disaster was mechanically really simple. During the tech boom, their deposits doubled to $124 billion. SVB took that cash and invested it in supposedly the safest asset on earth, long-term U.S. government bonds. But when the Fed aggressively raised interest rates in 2022, the value of those old, low-interest bonds absolutely plummeted. Suddenly, SVB was sitting on $17 billion in unrealized losses.
They bought toxic, actually scratch that, they didn't buy toxic assets at all, they just bought bad duration. When SVB announced a massive loss trying to raise capital on March 8th, venture capitalists smelled the weakness. Group chats instantly lit up. In a single day, March 9th, customers tried to withdraw $42 billion, almost a quarter of the bank's entire deposit base in one day. SVB's cash balance went negative, and by the next morning, the government seized it. Fear spread at the literal speed of a text message.
Which really brings us to the root cause of SVB's collapse. What exactly is interest rate risk? I mean, how can the safest assets in the world kill a $200 billion bank?
Let's move to and see how this builds, because it all comes down to a fatal mismatch. Banks have to practice asset-liability matching. Liabilities are your deposits. Those are short-term. Assets are your loans and bonds, and those are long-term. If interest rates spike, the cost to keep your depositors' money goes up immediately. But the income you're making from those 30-year mortgages or 10-year bonds, that is totally stuck at the old, low rates.
It highlights a pretty harsh reality. A bank's internal math might look perfectly healthy on paper today, but the entire economic environment is utterly dependent on the Federal Reserve. When the Fed changes the overnight funds rate during their meetings, they instantly alter the cost of every single deposit and the value of every single loan on a bank's balance sheet. Let's bring this all back down to earth, back to that hypothetical $15 million community bank we started with. In a good year, with the 3% margin, you pay all your massive expenses and walk away with $620,000 in profit. Not bad, though. You know, it'll take 24 years to recoup your initial investment. But in a bad year, rates rise, your margin compresses to 1.5%, and a recession causes loan defaults to spike. Suddenly, you're losing money every single month. 2 or 3 bad years, and your tiny equity cushion is completely consumed. Your bank is done.
Which leaves us with this final, profound thought from our source material. If you buy a bank, you aren't buying a stable vault or some predictable stream of income. You are buying a machine that turns trust into money, and it runs entirely on the assumption that the trust never runs out. And as history continually proves, when the trust evaporates, no capital buffer in the world moves fast enough to save you. Really makes you look at your checking account a bit differently, doesn't it?